welcome. You're watching Business Today Television. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand the closing action on the D Street. Last 45 minutes remaining, and you can actually see that the Nifty is still hovering about 23,250 odd mark. There's been a very narrow band of trade, but the markets have actually held their ground, not fallen too much when we talk about the impact of tariff war is concerned. Remember, we opened on a volatile note, but we've actually held above 23,200 for the large part of the trading session, and that's being seen as a big relief, as for the anticipation was that the markets could react very, very sharply, looking at what happened overnight with the US futures this morning, as well as in the Asian markets as well. Now, to really help you understand what the current market setup is like, the pharma index continues to soar higher. You can actually see an over 2% kind of a move on the Nifty Pharma Index. That's the top moving one. PSU banks have garnered some strength. You can see a 1.6% move on the higher side. Consumer durables, there are slight gains on the private sector banks as well, and some small cap names are also doing well. On the Nifty, remember, it was an all across green screen when we talk about the pharma names, but even power grade from the PSU names is now soaring higher, 3.5% up, along with the pharma names like Cipla, Sun Pharma, Dr. Reddy's that continue to shine bright. Along with this, you also have names like Shriram Finance, Ultratech Cement that's been up and about on the Nifty today. When we look at the kind of drags that we have on the Nifty, well, you do have HCL Tech, TCS, Tech Mahindra, Infosys, Wipro. At least 4 of the top 5 losers continue to remain from the IT pack. Let's try to understand the impact of tariff announcements on the markets and how do you really see the markets going forward from one of the top guests who's now joining in. Mr. Sudeep Bandyopadhyay joins in, Group Chairman of Indie Trade Capital. Warm welcome to you, sir, and thank you so much for taking the time out. I want to first begin by understanding from you, the tariff announcements came in as expected, but the quantum I want to understand. Is it, more than what was being anticipated? Is it in line, or is it more or less more convenient for what the markets were already anticipating for Indian perspective, sir?
It is definitely much more than what was being anticipated. But what has happened is, when you look at the competitive landscape, let's say you look at the textile industry, the other countries which compete with India for the market share in US is Bangladesh, Vietnam, China. Now, the tariff imposed on all these 3 countries is much higher, significantly higher compared to what it has been imposed on India. So obviously, we are at a competitively better off position. And I think the market is factoring that in and rejoicing. That's why you will see the textile exporters are doing well today. Pharma, of course, because it has been kept out of the ambit for the time being, it's rejoicing. So pharma also is doing good. But there is no denying of the fact that this is definitely a significant blow to the global trade. And, the full repercussions of this haven't yet been understood because there will be second, third degree impact. Look at IT. Now, IT doesn't come under any tariff. But if there is a slowdown, stroke recession, stroke some kind of stagflation in US, IT definitely will suffer in a big way because IT budgets will be cut, projects will be slashed, ongoing projects may be held back. So there are concerns, and there may be concerns in multiple areas in the automobile industry as well. So the way I look at it, I think it will take a little more time for the markets and everybody else to digest this properly and understand the secondary, tertiary impact of the tariffs which have been imposed, all across.
Fair point, sir. So you did talk about, how IT is being really looked at this point in time, autos as well. But what about pharma space that has been left out? We have seen a relief rally going. But what's your outlook here? Is it only in the interim, the first relief that has come in? Could it come later on? How should one be prepared on pharma space, since that's also one of the key export-oriented sectors?
Well, if one tries to analyze logically, pharma should be left out because, manufacturing a drug in US will cost, between 7 to 8 times more compared to, when you manufacture the same in India. So it probably doesn't make much sense to try and do that and bring back pharma manufacturing into US, particularly the generic and the CDMO operations. So hopefully these will be left out. But as things stand today, one cannot be sure because there's a specific carve out for the time being for pharma, but that may not continue in the long run. They can be brought under a separate tariff structure at a subsequent date. So very difficult to predict at this stage. As of now, I think pharma is out, and the industry and the kind of markets are rejoicing that fact.
Okay, so you did point out about the impact of this trade war could be on the economy, slowdown in the global economy, and there is a risk of recession as well. Do you think more than the direct impact of what the tariffs have been put on India, it will be more impacted with what happens around the world and the global economies by way of slowdown as well as rising inflation or the possible recession risks as well? Do you think that is a major risk factor for India at this point?
Absolutely. I think as the tariffs have been rolled out, India is in a relatively better position vis-a-vis many other countries, and that puts India in a better position to kind of negotiate and go carry on with its business. But unfortunately, the impact of the this trade war will have significant economic impact on the global economy as well as US economy and many other economies. Now, one has to wait and watch how things pan out. If there is a global slowdown, if there is a recession or a slowdown, significant slowdown in US, obviously Indian economy does get impacted. Multiple sectors which do business in US, case in point, IT we talked about, automobiles we are talking about, and textiles, many other sectors will get adversely impacted. If US consumption comes down, global consumption comes down, investors become risk averse, global markets start coming down, and FIIs start pulling back and going back to fixed returns instruments. So it can have a cascading effect on Indian financial markets, Indian economy, and the global economy as well.
Okay. Yes, sir. That's what I was coming to. What do you foresee for what's lying ahead for bullion, alternative asset classes like cryptos or dollar for that instance, because all the fund flows will be done by dollars now. And if that is were to the case, how should one look at these two or three aspects?
Crypto, I think, has been falling, and if the risk on mood is off, if the people become risk averse, I don't think crypto has a chance. So it will suffer. As far as the dollar index is concerned, one has to see how things pan out. The US administration does want it to come down so that their competitiveness goes up, but we'll have to wait and watch how things pan out. As far as gold is concerned, I think it continues to remain a safe haven, and it will become more and more so under the current circumstances.
Okay. So, sir, help us understand now what should be the ideal way how a retail investor should approach the markets. Is it an event now done and dusted? Could there be much more uncertainty in the days and months to follow? And therefore, how should a retail investor be really looking at their portfolios?
Clarify this. I don't think this is done and dusted. Yes, first round has happened. One doesn't know, the full impact. It'll take some time before we understand the impact. Second, I think we don't know how other economies will react. China is already making some noises about retaliatory measures. EU is talking about putting taxes or some kind of charge on services, because services is one area where US has a surplus with EU, and they're talking about taxing services coming out of US. So there will be many countermeasures. We'll have to wait and watch what kind of countermeasures come and where this trade war settles. It's very far from getting settled at this stage. So we'll have to wait and watch. Now, as far as retail investors are concerned, I think it's better to also wait and watch. If you are planning for investing for long term, I think there are interesting opportunities emerging, and maybe if there is some more correction, some more interesting opportunities will emerge. Focus on domestic focused and domestic facing businesses, whether it's a construction, infrastructure, power, cement. Look at these kind of industries. which to a great extent is insulated from the global trade war and global recession and things like that. But of course, if there is a major recession worldwide, India also will get impacted to a certain extent. These companies and these sectors also may get impacted. But the way Indian economy is poised, the way Indian inflation is shaping up, I think some of these domestic facing sectors are doing well and are expected to continue doing well.
Okay, so let me push you a bit. Since you talked about three or four sectors which are domestic oriented, and you believe investors should now focus on spaces like construction, power, our own infra spaces. What are some of the names that one could really look at from these sectors, sir?
Well, Larsen Toubro in the infrastructure sector comes to my mind straight away. I think it's a good company doing well. They recently won the largest possible order from Qatar. There are these orders, new orders, which are coming from international market are for additional margin, increased margin. So overall margin profile of the company is changing. So it makes sense to invest in Larsen Toubro at current level.
Okay.
Valuation also is reasonably okay. So from a long-term investor's point of view, it's a good buy. If you're talking about power, again, look for the top company in the power sector, which is NTPC. I think it's got a fantastic forward and backward linkages, whether it's coal linkages, which is the backward linkage, or the PPAs for the forward linkages. It's all done. The green energy subsidiary is doing well. Power demand is strong and is expected to remain very strong. The capacity is increasing. So all the boxes it does get ticked. And valuation wise also, it is not cheap, but there is significant upside potential is what we believe. If we have to look at some of the other sectors like a cement, again I'll say that go for the leader there, Ultratech.
Yeah.
The demand was weak in Q3, but in spite of that, they performed commendably. The costs have been managed very well, and Q4 onwards, expectation is demand has picked up, so the performance will be even better. So I think these are some of the names one can look at. These are safe and steady investments under the current circumstances.
Okay, but Mr. Padmanabhadhyay, will there be any sectors even in the avoid list? How would you look at that?
Well, definitely IT is an avoid list at this stage because very clearly we are looking at a significant turmoil in US economic scenario, whether it's inflation, or whether it's a recession, stagflation, one doesn't know, but there is a turmoil. So IT is definitely an avoid.
Okay, IT is definitely an avoid, sir. Earnings season is going to kick start in about 8 days odd, and IT will be the first one to really, look at what the earnings are for the previous quarter, and of course, give us an outlook going forward. Do you think much more importance will now have to be given, and will there be again a lot of uncertainty from within the commentaries what the IT companies really make as to how they see the future, especially in the US, which is their biggest outsourcing partner?
Oh, absolutely. I think Q4 numbers will be of less significance. What will be of significance is the what they talk about the future, and that's commentary will be most critical. I think I have a feeling that most of these companies will kind of give a kind of a vague future outlook because everybody is unsure. So how
Yeah.
can somebody be sure in that position, handling that kind of a business? So if you are expecting some clear commentary one way or the other, I don't think that's going to come. So it's better to wait and watch.
Better to wait and watch on the IT pack. How about the banks, sir? Since that also was a consensus play right from the beginning of the new calendar year, how are you looking at banks, financials, NBFCs? Do they still provide you that safer hedge?
They do provide to an extent. And look,
Okay.
India domestic inflation has come down, and expectation is that RBI will cut interest rates in the next policy. And with that happening, they will further have an opportunity of improving performance. And evaluation wise, also they are reasonable, I would say. So again, taking names, look for the leader. SBI at current valuation does look good. All the boxes are getting ticked. Credit demand is increasing. Asset quality has improved. Subsidiaries are all doing well. Margin is decent, and with the interest rates coming down, the margin expansion should happen. So look for the leader in even in these sectors.
And what about the one, I forgot to ask you about the auto space largely, since that's going to be the biggest hit. In fact, that's the first one to be hit, since tonight is when 25% tariffs on auto and auto components does come into effect. So that's the first tariff that actually goes into effect. How would you look at the Indian auto story?
You have to be very selective. And, as I was mentioning, companies having export businesses, companies selling into US is definitely an avoid at this stage. Let's say Tata Motors, 25% of JLR, Jaguar Land Rover sales is in US. That will start attracting 25% tariff from today. So obviously there will be a challenge as far as sales is concerned. So it's very clearly an avoid. Many other auto component companies, auto manufacturers have export business. How that will get impacted in this entire, the tariff tantrum is a little difficult to predict. So I would, let's say, if I have to choose an auto company, I will focus on a domestic focused auto business. And I do like Mahindra and Mahindra in any case. They are completely domestic focused. The numbers, as far as SUV is concerned, they are beating everybody else. The business is robust. Tractor volumes are increasing, and assuming there is a good monsoon, rural income is increasing, so the tractor volumes also should go up. They have announced the EV models and expected launch dates and things like that, so that also looks interesting. So I think Mahindra and Mahindra at current level, from a pure if you want to avoid this tariff tantrum, that definitely looks a good buy.
Okay, fair point. Well, Mr. Bandyopadhyay, thank you so much for sparing your time for us and explaining to us the impact of these tariff tantrums and how does a retail investor really navigate through these fresh uncertainties that are upon us at this point in time. Always appreciate your presence with us on Business Today. Thank you so much, sir. All right, 23,252 on the Nifty. We are at the last 25 minutes of trade on the T-day, and we are now joined by another special guest. Mr. Gurmeet Chadha joins in, co-founder and CEO of Complete Circle, now with us. Warm welcome to you, Gurmeet, and thank you so much for joining in. I'm sure from last night you would be up and about, looking at all the fine prints, the statements that were spoken, and of course the detailed annexures that have come in. By now you would have really found out what exactly, the Trump's tariff announcement mean for a country like India. Tell us, what's your first thought? Are we really in for bigger blows from here on, or do you think it's done and dusted for now?
No, I think we are probably at the midway, Sakshi. I think it's a disruption. You will see a lot of realignments of supply chain. You will also see a lot of regional trade and bilateral treaties, including India and US, which will happen over a period of time. So this is a bit of a new economic order getting reset, and it doesn't get factored in a day. In fact, if you see, the tariffs will be applied more from 9th April. 10% comes into effect from 4th. The balance actually comes into effect from 9th of April, which means that there will be a lot of to and fro in terms of further negotiations. And we need to see how China and EU and countries where the tariff rates are excess, are effectively reaching 50%, react to it. So I think the second phase is critical, and I think we should not jump the gun. From the first, I think one day at a time is a is a good thing to do. Sometimes just let things pan out. I think let things get priced in. Markets will take its time to factor in the damage it can have. So I think the question now is more the US slowdown. It is now less on, see, our export to US as a percentage of GDP is 2%. Now, if you put tariffs 20-25% on 2%, that's 0.5%. But it is not as simple because there are second and third order impacts. So now if US materially slows down, what it does it to your IT sector, what it does to your overall export, what it does to the global growth. So I think that's where the question will sit. And market will take a few days to, get that price in. For now, I think if you're getting good bargains in domestic sectors, which is, let's say, financials, travel and tourism, your domestic pharma, where the linkage to US is very low. Those are the spaces to be in. But let things pass, right? And then probably take a call.
Hmm. But like you pointed out, I think the bigger concern is what the trade war does to the global GDP or the economy. What are the chances that you feel US could enter into a recession? I mean, this was long buried talk, We had not been talking about it, looking at how buoyant the US markets were. And 2 months into the presidency, and we've seen an optimism turn change into nervousness for the US markets, and therefore another sign of whether we are at the risk of a recession again. What are the chances there, and what would that mean for India?
So I think they will definitely slow down. Whether there is a hard landing or a soft landing is the debate. And I think they want, probably, I think a lot of it is intentional. Look at the 10-year bond yields in US. We are already down to almost 4%, 4.04 today. It had almost got close to 5%. 480 was, I think, the peak of 490. So it's almost like an 80, 90 pips drop. When Trump came in, it was 370. And they have about $6, $7 trillion of debt, which is supposed to be refinanced, rolled over this year. So they would want the bond yields lower, and I think some of it could be intentional, which is more of a, they called it detox. But a 5-10% fall, you would not blink. But if it's a larger fall, then you have to see how US blinks. So that's why I'm saying I think the bigger thing to watch is US markets right now and how we negotiate. I think India has a head start in terms of our trade talks are already on. So
Yeah.
our that's why our tariffs has been slightly lower. So if we can renegotiate and get things back on table and get some things off. So for example, auto, right? I think our finished vehicle is just $0.2, $0.3 billion. Our auto components are around $2.5 billion, right? So we need to figure out which components where we can, how we negotiate that. Textiles, we are now at a relative advantage over a Bangladesh, Vietnam, Indonesia, China, where the trade, China is now 50, Vietnam is 45, 46%, others are 30, 35%. So there is
Correct.
a relative advantage there. So I think markets will take a few days to process it. Until such time, be on a preservation mode, get bargains on domestic side. No harm in adding some bonds also to the portfolio. And then sometimes, Sakshi, not doing much is the best thing to do.
Not doing much is actually the better thing. Let me just press you a little bit more. You did talk about some of the sectors that are at the risk, whereas others that may have the advantage over the other countries because of lower tariffs. I wanted to ask you about electronics, especially when we talk about US companies having just set up in India, like Apple. I mean, we were happy about Apple setting up manufacturing all the phones from India, the latest iPhones. What happens to such companies and such plans now?
Electronic supply chains actually are very, very complex. So it doesn't that, some things can't be disruptive overnight. Yes, incrementally, there will be pressure on Apple or any US players to set up more facilities in US. I don't see much stress in terms of big disruption happening because, I think what is there takes time to set up. These lines are set up over a period of time, and incrementally you keep adding capacities. You need special skill sets to get into it. So I don't see much. Also, electronic exports, again, you are again at a relative advantage. Look at what
Yeah.
Taiwan is charged with. Look at where others are China is. So I think there is a tariff relative advantage. Second, the supply chains are complex. Similarly, pharma. I think the supply chains are too complex to
Yeah.
immediately. So there's a direct cost healthcare which affects people directly. So I think relatively pharma first and maybe electronics second are two supply chains where disruption would be at a margin, not in terms of earth moving. Yes, valuations of some of the EMS companies are in three-digit P. That's a separate matter. That there's some correction happens. That's a very different thing. But purely from a business perspective, I see marginal impact. I don't see a big impact as far as electronics and healthcare is concerned.
Right. Now, you do point out how India is seemingly better off because of lower tariffs vis-a-vis China or a Vietnam or in Indonesia, the other Asian countries. Would that be enough to, again, let the FIIs look back to India in a positive, from a positive lens once again and come back? Do you think that is a case that one should be looking forward to?
See, I think I'll be happy if they stop selling for now, rather than getting incremental allocation. I think that's the first sign. So I think March we did see some tapering down and then picked up a little bit in first week. So first thing would be to see if the selling pressure comes off. I think that would be day one. I think first would be the flight to safety. You'll possibly see initially money moving more towards bonds, US treasuries,
Yes.
safe haven assets. And then I think the broader movement probably will be from the big tech in US, which is overowned in most portfolios, and which even US Trade Secretary did mention that yeah, it has to move from Max 7 to the larger American stocks. So I think the bigger movement will then happen from the big tech to other places. And I think Some markets like India, which is more domestic, I think should eventually benefit. But as I said, it's a little too early. Let things get factored in first. Some of the damage is in the price. So if you're really brave-hearted, you can start, nibbling in now. But my bet is wait till ninth. Wait till ninth. Let things get more clearer in a few days, and this is going to continue for some time. So you're not missing out anything. So you'll get enough opportunities as we go along.
Okay. But how about the other asset classes that have been left out? Gold, for instance, which has already been celebrating fantastic move over the markets. I mean, 32% of a rally in FY25, and the conditions continue to be more and more conducive for bullion. How would you look at that?
Things can change quickly. For now, yes, I agree with you because central banks are also net buyers, domestic household, of course. The jewelry exports will take a bit of a hit. So if you see, especially Indian gems and jewelry, diamonds we had, polished diamonds we had zero duty. Now the effective rate is 26-27%. Silver jewelry was 5%. Now the effective rate goes up to 32-33% with the average jump. Same the cases with gold. So you have to be a little careful where so something like Titan may not have a big export number, but there
Yeah.
are a lot of in lab diamonds, etc., where the export numbers are higher. We have to go level two. So I think the market will take 3 or 4 days, 5 days to process. I think earlier the issue was there was no quantum to process. Now you have a certain rate to process, and that rate will also get evolved over the next few days as negotiations happen. So that's why I'm saying good thing to do right now is something which has little or low linkage. Banks, financials, domestic travel and tourism, domestic pharma. So look at the internal sectors more for now, and then once there is more clarity, go towards exports and other opportunities.
Okay, so we've understood from you how our approach should be on the domestic markets and look at the internal looking sectors. But if you, as a global investor, how would you probably now shift your asset allocation? What will you change there?
So I think people had actually disregarded asset allocation last year because people had forgotten fixed income. I remember discussions with some clients saying 6-7% is too low in fixed income. I think and market has its own way of bringing sanity back, which it has done
Yeah,
for
yeah.
2 weeks. I think have a balanced allocation. I think the 10-year bond, for example, still has a lot of juice in it. I think you will see more rate cuts in India as the government looks to revive growth, push consumption. So I think that you can have some bonds which are long duration in the portfolio, have some commodity exposure through gold, etc. There's one category called multi-asset funds where the fund manager takes a call between commodity and bonds. I think that's one category retail investors can look at. And on equity, be a little more large capish, more domestic right now to begin with. Don't completely write off equity also, because when there are no bargains, when there is trouble is where you get bargains. When everything gets sorted, you will not get current prices, right? So if you are an investor, you want to build a portfolio, there'll be a lot of opportunities over the next few weeks. Build it, but be a little more balanced, and more importantly, reset the return expectations. This is not going to be 20-25%, which we are used to for last 2-3 years.
Yeah, okay. Also wanted to get a sense from you when it comes to the domestic sectors now, if you could help us understand which will be the sectors that would probably be more efficient in weathering the storm if there has to be one or two more, discussions on tariffs that could continue to keep the boat rocky. How would you really look at those sectors that could provide you that safer hedge?
So I think consumer discretionary domestic is looking
Okay.
pretty solid. For example, travel and tourism. I think that's one wallet where consumption basket where the wallet share keeps going up, especially with the new generation, Gen Z and millennial. It's the largest pocket. White goods and appliances, I think we'll continue to see. We have a long summer season ahead. February and March were pretty warm. I think we'll probably have 8-9 months of summer, much harsher summers. So some of the AC makers, some of the AC component makers may fit in that bill. Uh, I think banks look sweet. I think both from a valuation point of view, and that there will be treasury gains, and that will offset NIM pressure. Credit growth is slightly inching back again. Government spending is picking up. So some defense-related names we are seeing a lot of ordering now, domestic also and international also. Especially in drones, Pinaka rockets, etc. And you have to go level two, level three now. As I said, earlier you just bought a defense index and that probably would have made money. So right now you can't say I will buy textiles or I'll buy defense or I'll buy only banks. I think you have to go level two, level three, and then make a portfolio. So need a little bit of hard work, but for next few weeks, be on a preservation. It's important not to lose money right now and then gradually build it over a period of time.
Okay. Yeah. Um, also help us understand, we're just going to be getting into the earnings season with IT starting it all off. And again, like we are noticing that IT could be probably again reflecting some uncertainty in the commentaries when it comes to what is the outlook going forward because of these new change in policies. How would you really look at the earnings season as a whole? Where do you think one can keep their focus on? Where could green shoots emerge, and where could there could be continued problem for one more quarter?
I think IT could be mixed. I think the numbers may still be okay. I think the commentary I would like to watch out for, especially for the IT companies. But some of the pain is now getting captured in valuations. So if you get large cap IT at 14, 15 times, probably large part of the pain is there. So I mean, if it corrects another 10%, then the valuation would probably be interesting, especially as far as the large cap IT is concerned. But as I said, commentary would be important. We've had two sad quarters of earnings. Q2 was 4% EPS growth. Q3 was hardly 7.5%. I think it's important we do a double-digit EPS growth, and downgrades don't outpace the upgrades. I think we've seen two quarters where there have been more downgrades, 60% downgrades. So, and market is about 18 times right now. Small mid cap index is still 22, 23 times. So if you don't get a double digit earning growth, it would be difficult to even sustain 23, 24,000 levels. So it's important that we get a double digit EPS growth and be in pockets where you get earning growth. I think that's your biggest cushion to volatility, which is what we are seeing right now. So Bank Nifty has been solid because probably the results on the banking and financials will be better than rest of the market. So to me, earnings are extremely important, and I think that's where the focus should be rather than worrying about tariffs and all, which are completely beyond our control.
Consumption is another theme that we were discussing, and I want to understand from you. 1st April has started on, and this was the time when we were all hoping that finally the tax cut benefits will start to pour in into the markets. Which are the pockets within consumption that you are more bullish on, where you believe that immediate or first reactions of bullishness could start to come in?
I think, as I said, travel and tourism looks good. I think hotel
Okay.
stocks will have a strong set of earnings. I think airline, uh, 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 I think should do well. Indigo, for example, now virtually will add one aircraft every week after 6 months. They are starting new routes. Business classes started. Load factors are pretty decent. So I think and few food prices are well behaved. So looks good from that point of view. And white goods, I think, look good. I also think the food are not the staples in FFCG, but the food businesses. There's been some sign of both rural and urban uptake. We saw that in the commentary of Tata Consumer and Imami a couple of days back. So that would be another pocket I would be really keenly interested in. And once the market stabilizes, I also consider capital market plays, whether those are mutual fund AMCs or depositories or exchange, as financial consumption or digital consumption. I think that probably with a lag of a month could be part of your overall consumption.
Okay. Also wanted to just ask you, when it comes to the market cap differentiation, mid and small caps as well, what is your approach right now? Enough and more has been discussed over the last few months of froth, steep valuations, a lot of excesses being here. What is your current approach to mid and small caps? Are they done with all the excesses being taken out? Is there more vulnerability to be had? What exactly, how would you approach this?
No, I don't think so. It's fully done. I think maybe some pockets is done, some pockets are still rich. Mid cap IT, despite the turmoil, you're still trading at 40 times, 50 times. I think it would be difficult to sustain if US really slows down. There are pockets in for example, consumption space where again mid cap is expensive. Some of the new age names are quite expensive, so any moderation there could be a bit of a problem. So I think but there are pockets, as I said, where valuations have become so. If you can grow 20% and you are at 25, 30 times, probably market will be okay. But if you are at 50%, 50 times, and you deliver single digit or early double digit earning, then this market would be pretty punishing.
Yeah, okay. In the end, Gurmeet, just help us understand. Say there are a lot of those first time investors who would have entered after this correction has happened over the last 5, 6 months odd. And they may be now looking at an opportunity that yes, we have fallen about 14% on the benchmark level, about 20%, 25% on the broader markets front as well. Many sectors even further. How would you really advise them to start building their portfolios, looking at both the external shocks as well as the opportunities that they present themselves internally? How would you say, if I'll give you an example, that okay, somebody has 10 lakh rupees at this point in time and they want to now create a well diversified portfolio, how would you advise that first time investor?
So, assuming it's long-term money, and by long-term I mean it's about 5 years. See, one thing I've learned, and there's a very good data. If you put money in Nifty 20 years back, let's say 10
Yeah.
lakh rupees, and you would have stayed invested, the value is 1.5 crores. If you have missed the 10 best days, the value becomes 80 lakhs. And if you have
Okay.
missed the 20 best days, the value becomes 45 lakhs. So, and because it happens is because the worst day is followed by the best day. So don't get into the timing bit. Just stay long, be gold anchored rather than market prices anchored. A
Hmm.
fresh 10 lakhs to work, I would suggest, you have some allocation to bonds and gold and other asset classes, maybe 20-30% to begin with.
Okay.
Equity be a little more large capish. Just accumulate it over the next 2-3 months. Don't be in a bit of a rush, and keep stepping up. I know when prices go down, it's difficult to add because the cash is there, the courage disappears. But that's what good investors do. They don't waste a correction, and any good investor you meet, gets opportunities when things are not looking good. So be constructive. I don't think so. The 3 year, 5 year picture of India changes. I think what is happening is largely external, and I think a lot of it will come to our advantage, but it will happen over a period of time.
Okay, and just last one question. We started off this calendar year. Everybody was saying keep your expectations pretty moderate this year. We came down heavily. We've slightly recovered from the recent lows that we have hit. I want to understand from you what's the expectation, a realistic one that one can have for FY26 from the markets. Do you think there is any chance for the Nifty to retest the previous highs this year, or will it be postponed to the next year?
Honestly, I have no clue, but I think it's a futile game. All I can tell you is that if you see last 10 years, you have got 8 positive closings and 2 negative closings. If you go over 20-30 years, 75% of the time, index gives you positive closings. So, assuming this is not a good year, assuming this is nothing is going to change. And if you're really putting money from a 1 year perspective, I think you're better off in bonds right now. Don't
Yeah.
touch equity. But I also think a lot of negativity is in the price. So there is a good chance that if we negotiate trade deals well, the second half of the year can look better. But I would not put a number to it. I would say I'm constructive right now on the markets, and I'll get more constructive if I get better price points.
Okay, fair point. Well, Gurmeet, it's always a pleasure to listen to you and to understand all those important insights that you always share with our viewers. Appreciate your time. Thank you so much for being with us and hope to see you very soon in another edition of Business Today. Thank you so much. All right, viewers, last 5 minutes to go and we will start to wrap up the trade. Remember, this has turned out to be a day rather than being shocking on a price point, which is much better, has really only gone into contemplating what could be in the offing. We've actually got you the top market voices right from the morning before markets opened all up till now, and you've actually understood from a whole host of market voices that India perhaps is in a better spot than the others, even if the tariff blow has been dealt. That's one sense that's come in. The second key takeaway is that look at the domestic focus sectors. That's where you will be able to hedge your positions more, because there could be some more external shocks to be had. There are some unknowns as to what happens post the trade war. If it escalates from here, from various countries to the global economy at large, to global GDP, also what happens to inflation at large, and what will be the reaction of the central banks around the world on the interest rate factors as well. At this point in time, in case you have a shorter horizon, just like how Gurmeet said, better off to look at bonds, for instance, at this point in time rather than equities. There could be a lot of volatility at this point in time. experts also did point out the erstwhile highs of 2024 that we hit on the Nifty, 26,277. There could be a while away because there could be range bound trade, although the worst, most of the experts say, is already priced in. But do we have a chance to bounce back and go back to glory days? Not so much as yet, because there is still a lot of uncertainty that's across the world that needs to be penciled in, and we will have to see how things go. The other most important key takeaway from all the experts that we have spoken throughout the course is that India remains a bright spot for investments. They also see FIs coming back, looking at how things will change from here. They also expect that in case you are not invested in India as a global investor, India is the place to be, because India has a very strong domestic fundamental to back on, which may keep it more resilient from these external shocks vis-a-vis the other Asian peers, is what we are given to understand as well. Of course, a balanced, well-diversified portfolio is something that you really need to look at, is something that you all also need to keep in mind. 328, let's start wrapping up. 23,245 has been held onto on the Nifty. Pharma definitely heaving a sigh of relief, 2.2% higher, the top moving sectoral mover. PSU banks 2% up, small caps up about 0.5% to 1%. Private banks and PSU banks definitely pulled up some of the gains on the Nifty and the Nifty bank. You can see consumer durables up and about, slight gains on both the broader markets, mid and small caps. FMCG also garnering some strength, but the short weakness across the place. Most of the experts did say IT is really not in a good shape at this point in time. 4% of a cut for the IT index today, 4.2% of a loss for the IT index. Most of the losers on the Nifty are actually from the big heavyweight IT pack. Autos, the other ones that have been hit by that 25% tariff, is another one that's dragging about 1% lower. Metals, oil and gas also seem to be somehow under pressure. Top movers, power grid, about 4.5% higher in trade. It is the top moving share on the Nifty right now. Let's look at some of the other stocks. Sun Pharma, 3.5% up. You can also see, names like Ultratech Cement, again from those domestic themes that everybody is talking about, focus on construction, infrastructure, cement. Ultratech Cement seems to be buoying on that. Cipla, Shriram Finance are the other top movers. Laggards, TCS, HCL Tech, Tech Mahindra, Infosys, Wipro. 5 of the top 5 to 6 losers are from the IT pack today. PSU still holding their place, over 1% up in this market. You can see Power Grid, BHEL, NTPC, HAL, BEL, all of them buzzing in trade. F&O movers, IDFC First Bank, GMR, Airports Infra, AU Small Finance Bank, among others that have been on a up and about kind of a fashion. But what's dragging in the F&O? Again, no surprises. IT space, especially the mid caps, Persistent Systems, Coforge, KPIT Technologies, those are the ones that are dragging. Also Dabur, remember the business update again points out to be that Q4 could be another weak kind of a quarter, and therefore you can actually see the stock has fallen about 7%. FMCG volume trends continue to be subdued, and therefore you see Dabur dragging on the F&O factor as well. So the screen is frozen, viewers. 23,242. That's how the markets have shut shop. But at least the day has crossed over, and what we have seen is that it's not as bad as we were expecting it to be. Right after what happened to the US futures and the Asian markets this morning, India has rather displayed some sort of a resilience, or displayed that most of this news was already priced in. Let's hope that things turn out to be better, and probably things get digested more into the markets as we move into tomorrow's trading session as well. But the expiry session has panned out to be on a rather comfortable note. Slight losses, but that was more or less expected itself. 23,250, and that's the final print for you on the Nifty today. We'll leave you at that, viewers, but do stay tuned even beyond the market hours. The fine decoding of what Trump's tariff policies do mean for you and I as consumers and the economies at large. Stay tuned. We'll be having special discussions around that post the market hours.